Hey guys, welcome to Invest Crest. Today we take a look at index funds, which I believe are the safest and easiest ways to becoming a millionaire. So make sure you smash that like button and keep watching this video till the end. Warren Buffett, the investing genius, says index funds are very good investments. So what are these index funds? Before we get into that, let me tell you that Warren Buffett is an American investor. America is a developed country and people watching this video may come from countries other than America or even America itself. So when it comes to index funds, your region matters too. A developed country like America, where most of the adults are invested in the stock market, will have an efficient stock market and it would be difficult to find and buy an undervalued stock. So investing in index funds is a very good option as they generally give good and safe long-term returns for building wealth. But in growing economies like India, for example, there may be undervalued stocks with future growth potential. And even though index funds will still be the safest long-term wealth building option, there may be other areas to look at. I'll talk about this in a future video where I'll compare index funds and mutual funds, so make sure you're subscribed for that. For now, let's talk about basics of index funds. So many of you would have heard the name S&P 500, which is a US index. In this video, I'll be using Nifty as an example, which is an index of the Indian stock market. So when we say that the market has gone up by 1%, how do we calculate this? We say this because the index of the market has done positively, which shows the overall condition of the stock market instead of us having to check each and every stock individually. So the reason we need an index is because it tells us the overall report and health of the stock market. So here we have the Nifty 50 index, which tracks the largest 50 companies listed on the stock exchange. These companies keep changing, so if some company no longer meets the requirements, then it is moved out and replaced. And for replacing it, we have the Nifty Next 50 index. This shuffling is done every 6 months. Now these 50 companies in the Nifty 50 have more market share than the rest 4,950 combined. Just like how it is with the 500 companies in the S&P 500. There is a very less chance of permanent capital loss in an index fund as the companies are the best in the market, and even if one performs poor on a day, the others can more than make up for it. So now you know what an index is. So now what is an index fund? In simple terms, an index fund is a basket of stocks that you can buy, so you own a small portion of everything. It's like when you go to a cookie store where there's 100 cookies for $1 each, so you buy a combo box for $10 that has small portions of all cookies instead of buying all full cookies for $100, as picking every single cookie would be expensive. So here a cookie is basically a stock. So an index fund basically tracks the index. So if Nifty 50 has 50 companies, then its index will track and have those very 50 companies in it. So like I mentioned before, if two companies go out of the Nifty 50 and are replaced by two other companies, then the same thing will happen in the fund that tracks this index. So it's an exact copy of the index. Now why are index funds recommended and chosen by many investors? Now the first reason is cost. So in a mutual fund, the expense ratio is around 1 to 1.5% or higher, which means you have to pay that much percentage of your yearly profits as an expense to the party managing that fund. In case of an index fund, this expense ratio is 0.1 to 0.2%. Now these numbers of 1% etc. may look small and not much larger than the 0.1% of an index, but they eat up a large chunk of your total profit and sometimes reduce it by half. Like just for an example, from a profit of say $1 million, you may have like just $700,000 of a net profit remaining after the expense ratios are taken care of. I'll talk more about this in a future video comparing the two types of funds, so make sure you're subscribed and click the I button on your screen or the link in description. Now in the past, index funds have generally outperformed mutual funds over long periods, but more on this in a future video. Let's look at the returns Nifty has given. So in 2003, if you invested 1000 rupees in Nifty 50, then today it would be worth 14,503. So Nifty 50 has a CAGR of 15.47%, which is very good. This means 10 lakhs invested in 2003 would be worth 1.42 crores today. Now the Nifty Next 50, which like I said are the next 50 biggest companies, has given a return of 19.35%, that is CAGR. And all these returns are without dividends. So I have a video on dividend investing that you can check by clicking the I button on your screen or the link in description. We'll talk more about index funds and comparison in future videos, so make sure you subscribe for that. So that's all time for this video guys. Thanks for watching. Hope you learned something. Smash that like button as it helps the channel out, and subscribe for more such content.